What if your next stock purchase quietly destroyed your financial future overnight? Have you ever wondered why some investors consistently beat the market effortlessly? Most beginners lose money because they ignore one critical analysis process entirely. Today, you will learn how professionals analyze stocks before buying them carefully. Imagine choosing a stock that looks perfect but hides massive risks inside. The single mistake has wiped out entire savings for countless investors already, but professional investors never rely on guesswork or emotional decisions whatsoever alone. They follow a structured process to evaluate every stock carefully before investing. You are about to learn that exact process step by step today. Before buying any stock, understanding business fundamentals becomes absolutely essential for long-term success. Many people skip research and regret their investment decisions later in life. The truth is, stock analysis is not as complicated as it seems. You only need to understand a few powerful financial indicators clearly. First, these indicators reveal whether a company is strong or dangerously weak. Truly, today's lesson will change how you look at every stock forever completely. Think of stocks as living businesses rather than random price charts alone. When you understand business reality, investing becomes much more predictable over time. Prices move for reasons, and those reasons can be decoded clearly. Now, this skill separates successful investors from emotional beginners quickly. In markets today, you will soon see stocks differently than most people do today. Onwards, every great investor once started exactly where you are now, right here. The difference is they learned how to analyze properly, early on time, consistently. You are stepping into that same learning path right now, today, carefully. Most stock mistakes come from ignoring basic financial understanding completely in practice. That is why analysis matters more than hype or rumors always today. You must learn to separate noise from real information carefully every time. That ability alone can protect you from major losses in the investing world. Today's journey begins with understanding what truly drives stock value deeply inside. Forget shortcuts. Real investing requires patience and disciplined thinking. Over time, always, you are not just buying stocks, you are buying businesses themselves. Actually, that mindset shift changes everything about your investing journey forever in life. Now let's move deeper into real analysis techniques. Next, step by step, you will soon discover how professionals read stock data effectively always today. Each financial number tells a story about company performance clearly over time. If you ignore these signals, you invest blindly without insight, always in markets. But if you learn them, investing becomes far more logical and structured. This is exactly how wealth building starts for smart investors worldwide today. You are now ready to understand stocks like professionals do deeply. Finally, let's begin exploring real examples that will reshape your thinking completely today, because understanding stocks properly can transform your financial future forever. In life, we will now connect theory with practical investing scenarios. Step by step, real investors always look beyond surface level stock movements carefully. In markets, understanding fundamentals helps you avoid emotional trading mistakes over time. Always in investing, you will learn how to identify strong companies consistently over time. Now, this skill gives you confidence when markets become uncertain quickly. Always today, never rush into buying without analyzing key financial data carefully. First, always patience and discipline are your strongest investing tools in markets today. Always good analysis protects you from impulsive financial decisions over time. In investing, strong investors focus on data rather than emotions. Always in markets today, this mindset separates winners from average market participants clearly over time. Always, you are now close to mastering stock analysis basics step by step. Next, we will combine all insights into final strategy carefully today. Together, you will finally understand how to evaluate stocks properly in real markets. Let's prepare to conclude with powerful, actionable investing steps right now today. Your journey into smart investing truly begins from this moment forward, always. Today, we dive deeper into real stock analysis techniques used globally. Imagine opening financial reports that reveal hidden truth about companies instantly. Every serious investor begins by studying numbers before making decisions carefully. You will now learn how professionals interpret financial data step by step. Stock analysis starts with understanding income statements and balance sheets clearly. These documents show whether a company is truly growing or struggling silently. Many beginners ignore them and rely only on rumors or emotions. That approach almost always leads to financial losses over time. Instead, you must focus on the measurable performance indicators and ratios. Revenue growth is one of the first signals to evaluate carefully. It shows whether a company is expanding its market presence consistently. Declining revenue often signals deeper operational or competitive problems ahead. Profit margins reveal how efficiently a company converts sales into earnings. Higher margins usually indicate strong pricing power and cost control. Lower margins suggest increasing pressure from competition or rising expenses. You must compare margins with industry averages for better understanding. Net income tells the final profitability after all expenses are deducted, but smart investors never rely on net income alone completely. Cash flow is even more important for financial stability. Analysis: positive cash flow ensures a company can sustain operations smoothly. Negative cash flow over time signals potential financial instability. Risks: debt levels also play a critical role in stock evaluation. High debt can limit future growth and increase financial pressure. Low debt usually gives companies more flexibility. In tough markets, debt to equity ratio helps measure financial leverage accurately. Investors use it to compare companies within the same industry. Another key factor is return on equity performance metric. It shows how effectively management uses shareholder capital for growth. Higher return on equity often indicates strong leadership and efficiency. You should always compare it with competitors before deciding anything. Price alone never tells the full story of a stock. That is why fundamental analysis becomes extremely important here. Every number tells a deeper story about business performance. Reality: learning to read these signals takes practice and patience consistently, but once mastered, it becomes a powerful investing advantage forever. Financial statements act like a company's health report card. Strong investors read them before making any purchase decisions. Always weak investors skip them and rely on speculation instead. Dangerously, you are now learning how to think like professionals do. This mindset shift is crucial for long-term success building. Next, we explore how industry trends impact stock performance significantly. No company operates in isolation within financial markets worldwide. Today, external factors can dramatically influence even strong performing businesses unexpectedly. That is why context matters as much as numbers themselves. Smart analysis always includes macroeconomic and sector level evaluation. Carefully, interest rates can directly impact company borrowing costs and profits. Inflation can reduce consumer spending power, affecting sales significantly. Government policies may also create opportunities or risks. Suddenly, industry competition determines how easily companies maintain their market share. Strong industries lift all companies within them over time. Weak industries drag even good companies downward, slowly but steadily. You must always evaluate both company and industry together carefully. This combined approach gives a clearer investment picture overall. Now you are building a professional level analytical foundation. Let's continue deeper into valuation and pricing logic next. Now comes the part most beginners never expect in the stock analysis journey. Everything you learned so far is only the surface of investing reality, because markets often behave opposite to what financial data initially suggests. This is where true understanding of stocks begins to get tested. Imagine a company showing strong profits, yet its stock keeps falling. That situation confuses most beginners and shakes their investing confidence quickly. But experienced investors see something deeper hidden beneath those numbers always. Markets are driven by expectations, not just current financial performance alone. This is the first major mindset shift you must fully understand. Stock prices reflect future expectations more than present company conditions today. That means even strong companies can fall if expectations weaken suddenly, and weak companies can rise if future growth looks promising enough. This contradiction is where many investors lose money without understanding the reason. Emotional reactions to price movement often override logical analysis completely in markets. Smart investors always question why price moves instead of reacting instantly, because every price movement has a story behind it, always hidden. Sometimes that story is about future risks not visible in reports. Other times it reflects excitement that financial data has not confirmed. This gap between perception and reality creates opportunity for skilled investors, but only those who understand timing can benefit from these gaps. Now here comes another surprising truth about the stock analysis process itself. Even perfect analysis does not guarantee short-term price success always. Markets can stay irrational longer than most investors can stay patient. This is why patience becomes a hidden weapon in investing success. Many beginners panic when good stocks fall unexpectedly in the short term, but professionals often see such drops as opportunity rather than danger. The key difference lies in perspective and emotional control over decisions. Another important insight is that news does not always reflect truth. Markets often overreact to headlines without understanding long-term implications properly. This creates noise that distracts inexperienced investors from real value signals. Real analysis requires ignoring short-term emotional distractions in financial markets. You must learn to separate temporary panic from actual business decline. This skill alone can dramatically improve your investment decision quality today. Now let's introduce another layer that changes everything you know already. Institutional investors move markets more than individual investors ever realize fully. Large funds control massive capital that influences stock direction significantly always. Their buying and selling patterns often drive unexpected price movements suddenly. Understanding institutional behavior gives you a hidden advantage in the investing world because you begin seeing patterns others completely fail to notice early. This is where analysis becomes more psychological than purely financial always. Investor sentiment often overrides logic in both rising and falling markets. Fear and greed constantly battle inside every financial market cycle always. Recognizing these emotional cycles helps you avoid costly mistakes repeatedly. Stock analysis is not just math, it is also human behavior study. Once you understand this dual nature, investing becomes far more powerful. Now you start seeing markets as systems influenced by emotions and data. This deeper perspective completely changes how you evaluate every opportunity ahead. You no longer chase stocks, you begin analyzing behavior behind them. That transformation marks the difference between beginner and advanced investor thinking, and this shift is what leads to consistent long-term success. Most people never reach this level of understanding in the investing journey, but you are now developing insights that separate you from the crowd. Next, we will combine all these insights into practical valuation methods that will help you make real buying decisions with confidence always. Let's move forward and turn understanding into actionable investing strategy. Next, now it is time to transform knowledge into real actionable investing power because understanding stocks means nothing without knowing when to actually buy. Many investors analyze correctly but still enter at the wrong timing. Timing often determines success even more than the stock choice itself. And so you must now learn how valuation truly guides smart decisions. Valuation helps you understand whether a stock is cheap or expensive, but cheap does not always mean good, and expensive does not mean bad. Everything depends on future growth, expectations built into the price already. This is where price to earnings ratio becomes extremely important tool. It compares stock price with company earnings. In a simple way, lower ratio often suggests undervaluation, but requires deeper confirmation. Always higher ratio may indicate growth expectations or possible overpricing risk. You must never use one metric in isolation for decisions alone. Smart investors combine multiple valuation tools before making final judgment. Always another powerful metric is price to book value ratio analysis. It compares market price with actual company asset value carefully. This helps identify whether investors are overpaying for company assets, but even valuation ratios cannot tell the full story alone because future growth potential changes everything about current pricing structure. That is why growth analysis becomes equally important in investing process. Companies growing revenue rapidly often justify higher valuation levels. Naturally slow growing companies usually deserve lower valuation multiples in markets. You must balance growth expectations with realistic financial performance carefully. Always now comes another crucial factor called competitive advantage. Understanding deeply a company with strong advantage can dominate its industry for years. These advantages can include brand strength, technology, or cost efficiency. Without competitive advantage, even good companies struggle long-term in markets. That is why sustainable success matters more than short-term profits. Next, you must evaluate management quality behind every investment decision carefully. Strong leadership often determines company direction more than financial numbers alone. Poor management can destroy even highly profitable companies over time, so studying leadership decisions becomes part of smart stock analysis process. Now combine all factors into one complete investment evaluation framework. Financial strength, valuation, growth, and leadership all work together, always missing. Any one factor can lead to wrong investment conclusions quickly. This is why professionals never rely on single indicators alone, ever. They build a complete picture before committing money into any stock. You should adopt the same disciplined approach moving forward always. Another key insight is understanding market cycles and timing behavior. Markets move in phases of expansion and contraction repeatedly over time. Recognizing these phases helps you avoid emotional entry and exit mistakes. Many investors lose money because they ignore overall market direction completely. Even strong stocks struggle during weak market cycles, sometimes significantly. That is why timing combined with analysis becomes powerful investment skill. You are now learning how to think beyond basic stock selection methods. This level of understanding builds confidence in uncertain market conditions. Always, confidence backed by analysis leads to better long-term financial outcomes. Now you begin to see investing as structured decision-making system, not gambling or guessing, but calculated evaluation of business potential. That mindset alone separates professionals from emotional investors completely. Always, you are now very close to mastering practical stock evaluation framework. Next step is turning this knowledge into real investment action strategy, because knowledge without action never creates financial results in real world. Let's now prepare to conclude with powerful investing mindset transformation. Your final understanding will shape how you invest forever going forward. Now, everything you have learned must turn into disciplined real world action, because knowledge without execution has no value in investing journey at all. The final step is building a consistent stock selection routine forever. Every successful investor follows a repeatable process before buying any stock. This process removes emotion and replaces it with structured decision making. First, you identify a company with strong business fundamentals clearly. Then you check financial health using balance sheet and cash flow. After that, you evaluate growth potential and future earnings expectations carefully. Next, you compare valuation with industry peers and historical averages. Then you analyze competitive advantage and long-term sustainability factors. Finally, you review management quality and strategic direction of company. Only after completing all steps do professionals consider investing seriously. This discipline protects them from impulsive decisions in volatile markets. Now you must also learn one final critical investing principle. Never invest money you cannot afford to keep invested long-term, because short-term volatility can mislead even the best analysis. Patience is often the biggest advantage in stock market success. Most wealth in markets is created by holding quality companies long-term, not by frequent trading or chasing short-term price movements constantly. Emotional discipline becomes your strongest tool in uncertain financial environments. Fear and greed will always try to influence your decisions daily, but structured analysis keeps your decisions grounded in reality. Always, you must trust your process more than short-term market noise. Every drop in price is not a reason to panic immediately. Sometimes it is simply market emotion unrelated to company performance. Your job is to distinguish real problems from temporary fear reactions. That skill improves only through consistent practice and observation over time. Now you understand that stock analysis is both art and science. Science gives you numbers and ratios for logical decision making. Art helps you interpret future possibilities, and market psychology effectively. Combining both creates powerful investing intuition over time. Gradually, you are no longer just guessing in stock market decisions anymore. You are evaluating businesses with structured analytical thinking process now. That transformation is what builds long-term financial independence eventually. Remember, every great investor started with confusion and uncertainty initially, but they succeeded by learning and applying disciplined analysis consistently. You now possess the same foundational understanding they once built. The next step is continuous learning and real-world practice. Markets will teach you lessons that theory alone cannot provide. Every investment decision will strengthen your analytical thinking over time. Mistakes will become learning opportunities if you analyze them properly. Success will come gradually through patience and disciplined execution always. Do not rush the process or chase quick financial results. Wealth building in stocks is a long-term strategic journey always. Now you must commit to applying this knowledge in real life. Start small, analyze deeply, and invest only after full understanding. Over time, your confidence and accuracy will naturally improve significantly. This is how professional investors are truly built in markets, not by luck, but by consistent analytical discipline and patience. You now have the complete framework for analyzing any stock properly. Use it every time before making any investment decision carefully. Let this process guide your financial journey from this moment onward, because smart investing begins with smart analysis and disciplined thinking. Your future results depend on how consistently you apply this knowledge, and now you are fully ready to invest with confidence and clarity.